let's go on then to the Deferred Sales Trust. This is what you've been wanting to talk about. This is what you do. This is what you believe in. So how does it work? Tell me. I want to use this as an example, Brad. I am coming to you, and I'm going to make it a little challenging for you here because, again, most of the people who are listening to this podcast are real estate investors. Okay, so I have a $5 million asset. I have let's say I've got. Let's say I'm selling for $5 million, but I've only got, $2 million of equity, $3 million in debt. All right. I know how a 1031 works. How would this work with the Deferred Sales Trust? Why don't you sort of take it? You can describe what a Deferred Sales Trust is first, and then how this would work in this scenario.
Great. Excellent. So a Deferred Sales Trust is just a manufactured installment sale. Like a specialized installment sale.
Okay, so explain that because not everybody knows what an installment sale is.
So it's where you become the lender and you allow the buyer to borrow from you. So let's imagine this $5 million deal, Buck, which you own. In this scenario, you owe a couple $1 million of debt. You owe $3 million of debt. In this scenario, you could potentially loan the new borrow up to $2 million. Okay. Right, that's your actual equity in the deal. And so you become the lender. And in that scenario, the buyer puts less of a down payment and therefore they get into the deal. And on your side, you get to defer the tax until you receive payments from that. So with the Deferred Sales Trust, we're just actually asking the buyer to come with the full $5 million at closing. And we're asking them to actually buy the asset from the trust. And you're in exchange going to get an installment sale for the $2 million that was left over. We'll pay off your initial $3 to the bank. So
debt doesn't necessarily make this more difficult.
So it depends on the basis. So let me ask you that. What's your basis on the deal?
$1 million.
Okay. So you have
I'm going to make it harder.
Yeah, you have what's called a $1 million mortgage over basis. So in that scenario, we do need to replace that debt because what the government says is, Buck, if you close out on this deal or try to do a Deferred Sales Trust, you really already took that income. You took that money out of that refinance above your basis. Therefore, we're going to tax you as ordinary income. But our solution to that is twofold. Either, Buck, you either pay down the mortgage to the basis, or B, we'll do what's called a bi-fracture 1031. And it's really simple. We move your $2 million equity to a qualified intermediary, okay? And we purchase a partial Delaware statutory trust. I'm actually doing a deal right now for a client, very similar. He sold a 18-unit apartment complex in Sacramento for about 2.6, and he has about a $500,000 mortgage over basis. And so we found a Delaware deal, which has about an 82% LTV. So he's going to take 18% of that $500,000, and he's going to use that to replace the debt in the Delaware. So he has a little bit of equity into that deal, and the remaining can go into the Deferred Sales Trust. The key here is we just replace the debt, and that's what a 1031 does. That's what the Delaware 1031 does. We replace the debt. Remember, 1031 is equal or greater value, and also equal or greater debt. So as soon as we take care of that, you're good there. And the rest of it can go into the Deferred Sales Trust. So that would be hopefully the short answer to your question.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.